I would like to remind you that I am not a financial advisor. Anything I say here is for education and entertainment purposes only. You can and will lose money if you don't do your own research. Earnings per share, or EPS. What is it and how is it used? Earnings per share is used to measure a company's profitability on a per share basis. It is calculated by taking a company's net income and subtracting any preferred dividends and then dividing by the shares outstanding. It should be noted that EPS can be calculated as basic or diluted. Basic just means that you're considering the current shares outstanding, and diluted means you're considering all potential shares available if all convertible securities such as options, warrants, or debt are exercised. They can be calculated annually or quarterly, and the information can be pulled from a company's annual or quarterly reports. It is often used to compare a company's profitability to the profitability of other companies. For example, if company A has an income of $1,000 per year, 500 shares outstanding, and it pays zero in preferred dividends, it would have an EPS of $2 per share. And if company B has an income of $6,000 per year, 5,000 shares outstanding, and it pays $1,000 in preferred dividends, it would have an EPS of $1 per share. This means that company A is creating more profit per share than company B. The EPS is directly related to the profit of a company and its share count. We can see from the table here how the change in profit or shares will impact the earnings per share of a company. For example, if profits increase and the shares remain the same, then the EPS is higher. The only time it becomes more complicated is when both profit and shares both have a change in the same direction. Then the earnings per share becomes data dependent on how much one changed relative to the other. EPS by itself does not provide enough information to let an investor know whether a company is a good or bad investment. But the EPS value can be used as a tool in predictive models or to create ratios that help compare a company to other companies, industries, or sectors. In a DCF or discounted cash flow model, it is used to try and estimate a company's current fair value based on its historical earnings per share growth and projected future value. It is used in the PE ratio to calculate how many years it will take for an investor to make back its investment based on the current share price and its earnings, and to compare the company you're researching against other companies in the same industry or sector. Earnings per share can be manipulated. Some companies will manipulate the earnings per share by excluding certain debts or adding revenue that is not being paid for or collected, or a company will buy back shares at a higher share price to drive up the EPS. An investor can try and compare the cash flow per share to the earnings per share over several quarters or years, and that can help them identify any type of manipulation that might be taking place. Things to consider when looking or calculating the earnings per share of a company are extraordinary items, use of capital, dividends, share buybacks or dilutions, changes in accounting policies, earnings per share growth over time, and cash flow per share to earnings per share. If you found this information helpful and would like to see more videos like this or get notified when I release a new video, click the like, subscribe, and notification buttons. Leave a comment below if you would like to see videos on a specific topic. Thank you for watching and have a great trading week.